everything. And as mentioned on the invite, if you're interested in addressing your questions anonymously, feel free to write it on a piece of paper and then hand it out to Aya, and then somebody will ask that on behalf of you. But if you feel you want to ask the questions directly, that's fine too. That's okay. Okay. Without further ado, thanks.
Okay. All right. Thanks for inviting me. My name is Joe Chisholm. Is that okay? So let me ask: is everybody here an engineer?
Engineer. Who's engineer here?
Okay. Well, we have that in common. I'm an engineer too. I have a degree in chemical engineering. I worked as a chemical engineer in oil and gas and engineering software for nearly 40 years. During that period of time, I picked up income tax as a second part-time seasonal job, and I've been doing that since the early 80s. Then I went to Indonesia to live for 4 years and work in engineering, and then I came back here. My wife and I raised our kids here, and after our kids were grown up, then I started my tax practice again. So it's been kind of a little bit way back when and a little more recently. But anyway, I wanted to share with you some basics about income tax, and Rhea gave me some suggestions on some topics to start out with. And if the consensus is that you don't need to know that, I can skip those slides. But just to let you know, this was my planned agenda. Whoops. First, I was going to talk about non-U.S. citizen taxation, the definition between a resident and a non-resident, and how those two are taxed differently. And then I was going to talk about taxation of overseas income. That would cover, like, if, for example, you're living here, but perhaps you have a business or investments overseas. How is that taxed? And are you responsible for paying tax on that income? It could also cover if you're a permanent resident or citizen, and then you take a job overseas, how that income is taxed, and certain benefits, tax benefits that you may have for working overseas. So those are the things that I have planned for overseas, resident, non-resident, and overseas income. So as I get into it, if you feel like you already, or that topic doesn't pertain to you, just let me know and I'll skip it. And then that way we don't have to spend a lot of time on it. Also, when I give seminars like this, I'm very casual. So if you don't have to be quiet, when you see a slide, if I say something or if there's something presented that you have a question on, maybe it's not clear, please just raise your hand and I'll address your question right away. All right? Okay, so let's first take a look at the definition of resident versus non-resident. For U.S. residents, there are two residency tests, and I'll describe what those are in a minute. For non-U.S. resident, a non-U.S. resident is someone that does not meet that test. So that could include anybody from somebody coming over here on a short assignment from another country. They're being paid. They're a non-resident, so they don't file a 1040. They file a 1040-NR on that income. It's taxed a little differently. Not too differently, but a little differently. If you're a U.S. resident, you pay taxes exactly the same as citizens do. There's no difference. Okay, so let's take a look at these two residency tests. Tax residency doesn't necessarily have to do with any relationship with legal immigration. So in other words, you could still be taxed on as a tax resident even if you don't have legal status. So that's something to keep in mind. The IRS doesn't discriminate between legal and illegal immigrations. They want your money no matter what.
They don't care who it comes from.
Right? U.S. tax residents, that includes citizens as well as permanent residents and those who pass the residency tests, are taxed on worldwide income. So if you've got an investment account, oops, lost something. So if you've got an investment account overseas that's giving you dividends or interest, you have to report that and pay tax on it. If you have a partial ownership interest in a business overseas, even though it's all overseas, it's always been overseas, but you as a U.S. citizen or resident, you have an ownership interest in it, you have to report that. Okay. And one question that may come up, I'll go ahead and answer it right now. Well, what happens if I don't report it? How are they going to know? Believe me, the IRS knows. There are tax treaties with almost every nation in the world, and the U.S. uses, at least for the past 10 years, have been using some very strong-arm tactics in order to get income and financial information from other governments. So this information is shared, it's all computerized, it's not like it was back in the old days. So it's not very easy to escape.
So the idea, if that's already been taxed in the country that money invested, how does it work? So it's paid twice?
Exactly, and I will get into that. So that falls under a tax credit, and I'll explain exactly how that works in a little bit. Yes.
For example, there is an Indonesian citizen reside in US, and then they have business because they have a green card, for example, and then they have to report the tax, but then they have also to report to Indonesia because they are Indonesians. So it's like a double taxation, or how is it?
Yeah, and that's basically the same question, and I'll address that in just a few minutes, and tell you exactly how that works. But yeah, it does have to be reported. For non-residents, if you don't fall under one of those residency tests, if you're a non-resident for tax purposes, you only pay taxes on U.S. source income. So you can see right away that there may be an advantage to being a non-resident. There may be an advantage to being a resident. One of the things that non-residents get taxed differently than residents is if you're married, and in the U.S. you file married filing jointly. It's the most favorable of all the tax statuses. If you're a non-resident, you are taxed under the married filing separately status, which is the worst. There's only two filing statuses for non-resident, either single or married. And married, you get hit with the same tax code as married filing separately for residents, and that's a much harsher tax payment. Also, for any passive income that you may earn, like on dividends or financial accounts, anything like that, passive income, that you get a 30% flat withholding tax taken out. Now, 30% is pretty steep, especially if your dividends are maybe 10,000 or whatever. 30% of that's a pretty steep amount. So you can see how maybe being a resident is better in some cases, maybe being a non-resident is better in others. The tax residency tests, there's two of them. The first one is the lawful and permanent resident test, and then the second one is the substantial presence test. The lawful permanent resident test is the green card. If you have a green card, that's what you are. If you have a green card, there's no way that you can get out of being taxed as a resident. You're stuck. There's no claiming non-resident status if you have a green card. The substantial presence test, however, works like this. If you're physically present in the U.S. for 183 days over the past 3 years, counted according to this formula, all days physically present in the current tax year, plus a third of the days present in the prior year, plus a sixth of the days 2 years prior. Add all that up, if it comes out to 183, you pass the substantial presence test. Yeah. No, it's not, it does not necessarily need to be the same year. For a lot of people that are here on an H1 or a L1 or whatever, when you're initially here, you're probably taxed as a non-resident. But once you reach that 183 days, covering up to the 3 years, then you're a permanent, or I'm sorry, you're here under a substantial presence test, and you're taxed as a resident. Now there are some exceptions. There's a 31-day exception test. The substantial presence test does not apply if you've only been here for 31 days or less, or actually less than 31 days in the current tax year. So let's say you arrive here in December of 2017 or 2018. Then for that year, you're being taxed as a non-resident. And you stay here for the full next year, well then the next year you'll be taxed as a resident. Does that make sense?
No.
No?
What does it mean by residence? You stay here for how long? It will be considered as residence.
Right. Okay. So now again, this is for tax purposes,
Yeah.
not for immigration purposes.
Mm.
So for tax purposes, if you have been here for 31 days or less in the current year, you're a non-resident.
You're non-resident.
But if you've been there for at least 31 days, and then you count back the year before that, if you were here, you take a third of those days, and then the year before that, a sixth of those days, add it all up. If the total adds up to 183, you're taxed as a resident. So, say you're here on a work visa, you may not be taxed as a resident for a couple of years, possibly.
Especially those that goes in and out, right?
Exactly, because this is physical presence. So if you leave, then those days that you're gone don't count. That's a good point.
So that is on our fate, right? Because I don't think, will they know all those IRS?
No, you have
It's
to
our fate, it's our decisions, right? I'm falling into this or.
Right. And on one of the tax forms, if you're filing based on the substantial presence test, there's a form where you can show them the dates that you were here. Okay.
And current year always falls back to the tax year.
Correct.
So like what we're filing now, the
It's
current year is
2018.
2018.
Correct. That's correct. Thanks. Okay. So, yeah, okay, I put in this extra note there, under this exception, even if the 183-day threshold is met. So, let's say, for example, you came here in 2016.
They
How
leave
would
in
that work?
January. They leave in January, that's how it
Yeah, that would be it. They would leave in January. That's right. Then they could be taxed as a non-resident. That's right. Anyway, and then there's some additional rules involved with if you're married to a U.S. citizen, or if you're a U.S. citizen married to a foreign national, there are different rules that apply where you can actually have a dual status tax filing. I didn't want to get into that. The rules get a little more complicated. Anyway, and here's the last caveat. If you have a green card under the lawful permanent resident test, you're generally a tax resident regardless of the number of days spent. So if you have a green card, and let's say you get a foreign assignment in Saudi Arabia, and you're there all year, well, you're still a U.S. permanent resident because you have a green card. So you're taxed that way. All right? Under the substantial presence test, you may also claim non-resident status if these conditions are met. It's called the closer connection exception. You're present in the U.S. for fewer than 183 days in the current year, and you maintain a tax home in another country during the entire current year, and you maintain a closer connection to the foreign country in which you have a tax home during the current year. So, let's take a look at the definition of two of these terms, tax home and closer connection. A tax home is you have a regular or principal place of business, or you have a regular place of abode in that country. So let's say in Indonesia, let's say you come here, you do perhaps meet the substantial presence test, but you have a closer connection to Indonesia. You still have a home there, your family's there, your children's there, bank accounts, all your assets are there. That means that you have a closer connection. So you can claim closer connection status and still be a non-resident, if that's what you want to do. And like that last note there, it says, these are rather subjective determinations. So in every case, if you file under that exception, your tax preparer should make a lot of notes describing your situation, so the IRS doesn't come back on you.
Excuse me.
Yeah.
So meaning that because they have the house and everything in Indonesia, they have to pay tax in Indonesia. And then they can get the exemption for paying tax here because they have a closer connection. Is it
Well,
like
it's
that?
it's not an exemption from tax. It's an exemption from the resident
Oh, okay.
status.
Non-resident
So
status.
it would be non-resident.
Okay.
And correct me if I'm wrong, Indonesia doesn't tax you on U.S. income, does it?
No.
It's only Indonesia's source income, right? Yeah,
No,
there's
there is a question actually from from Indonesia, somewhere in my accreditation. They work here, but then they ask us whether they have to pay tax in Indonesia as well, because it's also the same thing. The tax, whatever you do your business outside of Indonesia, you have to report as well to Indonesian government. And then I don't know whether it is only report or there is a consequence that they have to pay the tax for that.
Well, that's interesting, okay.
Because if it is applied here and it is also applied in Indonesia, so that person will pay double tax then.
Right, and we try, especially in these tax treaties, we try to establish rules so that double taxation does not occur. And I'll get into how that works from the U.S. side in just a couple of minutes. How it works on the Indonesian side, I'm not really sure, but I'll show you the U.S. side of it. So, one other thing that may come up is, when does your residency actually begin? And so there are rules governing this. So if you qualify as a resident under the substantial presence test, and you did not qualify in the prior year, your residency period begins on the first day that you're physically present in the U.S. So once you qualify as a resident, they actually look back at whatever that first day was that you established your residency here. Okay? There we go. Okay, nominal days of U.S. presence can be ignored. So what nominal days are like when you first come here, maybe you make one trip where you come here and you look for a home. You're only here for a week, maybe 2 weeks, and then you go back, you pack up your stuff, and have everything shipped here. Well, those days that you were here for a house hunting trip are considered nominal days, and they don't need to be counted in terms of your physical presence. They're called nominal days. They can be, but you don't have to. So you have a little leeway. And this is what I just described. Pre-assignment house hunting trip. So these days are only ignored for the purposes of establishing that start date. The ending date is generally the last day that you're physically here. So when your assignment ends, you get on the plane and leave, that's your last day of residency here. These rules do get a little complicated. Yeah, this is what I just said. Okay. Yeah, this is just a summary of what I just said. Okay, so now for overseas income. Now we can start talking about this double taxation stuff. We have 3 things that can help us reduce our taxes. One is the foreign earned income and housing exclusions. The second is the foreign tax credit, and the third is the foreign tax deduction. The foreign earned income and housing exclusion. This would be, assume that you're a permanent resident or a U.S. citizen. I'll kind of describe, I'll use myself as an example. When I went to Indonesia, I lived there for 4 years. So I left here, I went to Indonesia. So my tax home was now in Indonesia. My tax home was not in the United States. So to qualify for the foreign earned income exclusion, my tax home has to be outside of the U.S. Okay? Second, you must have foreign earned income. So when I went to Indonesia, I worked for an Indonesian subsidiary of a U.S. company, ARCO. Okay? So my income was foreign source income. If I was, now, where would this not apply? Let's say I was a U.S. diplomat and I worked at the U.S. Embassy. Well, that's not foreign source income. My salary as a U.S. diplomat is U.S. income. So diplomats are not allowed this foreign earned income exclusion. Does that make sense? Also, up until this year, members of the armed forces who were maybe in Afghanistan or Iraq were also not entitled to that. As of this year, they are. So that's been a change. And you must be one of the following. Let's see. I don't know, my battery is dead or something. Here we go. You must either be a U.S. citizen or U.S. resident alien, green card, who's a citizen, national, or national of a country with which the U.S. has an income tax treaty. So let's say, for example, you have a green card. Let's say I was a U.S. green card holder, and my country of origin, I'm a national of the UK. My company sent me to Indonesia to work. Well, I qualify for the earned income exclusion because I'm getting foreign source income. My tax home is now in that foreign country, and I am a green card holder from a country that has a tax treaty with the U.S. Okay? And secondly, a U.S. citizen or U.S. resident who's physically present in a foreign country or countries for at least 330 days. Now for that, number one, it's for an entire calendar year. So, when I first went to Indonesia, I landed there on, I think it was May 1st, so, of 1985. So in 1985, I didn't qualify for the earned income exclusion because I wasn't there for the full year, and I didn't hit that 330 days until the following year. So the following year, I did hit that 330 days, and I was there for all of 1986, so obviously I qualified for that then also.
That's pretty steep, 330 days.
Say that again?
That's like 11 months, right?
Correct.
I think the foreign earned income is like $100,000 exemption.
It's over that now.
Over
It's-
that now?
Yeah, it's 103 something. When I was there, it was a whole
That's
lot
why
less.
it's more.
Oh,
They made
so
330 days, because a lot of money.
the 330 days can be multiple countries. It doesn't have to be on that one tax home.
Correct. So let's say I went to Indonesia and I was there for 6 months, and then they said, okay, Jim, we need to transfer you to the Philippines. Well, as long as I'm outside of the country for 330 days, there's less. You're right. So what is a tax home? A tax home is the general area of your main place of business, employment, or post of duty, regardless of where you maintain your family home. Now, some people, when they went to Indonesia, some of my colleagues, they still had a home here, maybe they rented it out, or maybe they let family live there, or whatever. But they established an apartment or a rental home in Jakarta when they were there. Well, their tax home was then in Jakarta, even though they still owned a house in the US. Now for me, since I came to Indonesia from the crazy state, you might have heard of it, California.
Yeah.
California taxes you on worldwide income also. So when I left California, I cut all ties with California. I sold my property, I got rid of my driver's license, I tore up my voter registration card, I'm no longer there. So, had I kept any of that, California might have sent me a tax bill. So, yeah, we got rid of that real quick. Texas is like God's country. Texas won't do that to you. Your tax home is the place where you are permanently or indefinitely engaged to work as an employee or self-employed individual. Now that's a very important rule right there. Let me give you an example. Let's say, for example, my company sent me to Indonesia for a specified 6-month period, okay, which later turned out to be an indefinite period. Well, as long as I'm there for a specified period, it is not my tax home. If I'm there for an indefinite period, it is my tax home. So like in my case, when I went there, it was indefinite. It was a permanent assignment. So, but there are a lot of people who do go, like, there were people that would go over there that went for like 90-day assignments from Alaska. They went over to Indonesia. Well, they weren't entitled to this because they lived at the Hilton Hotel and, you know, lived high on the hog, and they got a lot of benefits anyway. They didn't need this. Yeah, having a tax home in a given location doesn't necessarily mean that the given location is your residence or domicile for tax purposes, but generally it is. So, what does bona fide residence mean? Well, the word bona fide, Latin, which means good faith, it's a good faith statement that I reside there for the full year, January 1 through December 31st. That's what that means. And my assignment is for an indefinite period of time. So I was just trying to define some of those terms. So, like you mentioned, for 2018, the maximum foreign earned income exclusion is $103,900. Now, what does that mean? Well, basically, it means that if I went to Indonesia and I'm getting a salary over there and I'm entitled to this exclusion, the first $103,900 does not get taxed by the U.S. If my salary goes beyond that, now it starts getting taxed. And does it start getting taxed at the high tax rates or at the low tax rates? At the low tax rates, exactly. So it's a pretty sweet deal if you qualify, right?
And become expatriates, you make a lot more money, right?
Yeah. Well,
Interesting.
and this has gone up a lot. When I was there, they just imposed this thing back then, and I think it was, my first year there, I think it was capped at 50,000. And then it went up a little bit, by the time I left, I think it was 60 or 65, something like that. So it's gone up quite a bit in the 30 years since I've been there. And now well, I think we had this back then too, housing exclusion. The maximum housing exclusion is 16% of the foreign earned income exclusion. So, let's say you got an assignment in Indonesia. You're making $200,000. So your first $103,900 excluded. Out of that $200,000, they're subsidizing your housing. You know, because I don't know what, I imagine real estate there is pretty crazy. Back then, in the 80s when I was there, it was pretty crazy too. I couldn't believe how much rent they were paying for the house I lived in, so it was subsidized. Well, 16% of that $103,900, about $17,000 or so, can also be excluded. So on top of that, so, you know, the two of these, if your housing's being subsidized, you know, you get to exclude about $120,000. Pretty sweet deal. So for 2018, the maximum housing exclusion was $16,624.